Hey folks, whether you're a homeowner or a small real estate investor like I am, it's critical that you have a good process in place to prepare for everyone's worst part of the year, tax season. Regardless if you hire a CPA or if, like me, you prefer to do your taxes yourself, these nuggets of wisdom will be very valuable. Today, I'll be sharing my process that I use to prepare for taxes, specifically around real estate. Let's get started. What you see behind me is my Google Drive taxes folder, where I have a folder per each tax year. Since it's 2025, I'll go into the 2024 tax assessment year. Within each tax year, I store all tax forms at this level, such as my W-2, my 1099 SA form, and my Uber forms for when I drive to and from work to get some additional money, which is effectively tax-free because of the mileage depreciation of my vehicle when I'm driving for Uber, which is why you see the business mileage file at the bottom where I record the number of miles I drive for Uber. But the focus is on real estate today, so let's go inside the real estate folder. Given there are a lot of files here, I'll first start by talking about the 5 different types of files found in here. Then I'll show one example of each type. The first type of file is what I call the rental book. This is the final file that is concise and summarizes everything there is: rental revenue, expenses, repairs and renovations, and so on. This will greatly help fill out all real estate tax forms, so either you or your CPA will be very thankful for populating this. Next file type, the 1098 forms. These are the forms that the bank you use for the loan will provide. It basically informs how much taxes, insurances, interest, and equity you paid for the home in that year. Next type, the expenses file. This file outlines every single real estate expense I had per property, such as repairs, renovations, utilities, and so on. Next file type are the income files, which are generated by the site I use to administrate all of my properties, apartments.com. These files show the total revenue per each property and are generated with just a click of a button. The next file type is the 1099K form, which is a form that apartments.com provides showing how much revenue I receive directly from renters through apartments.com. But I also received payments from renters through Venmo, as well as sometimes even through Zelle. So I'm going to have to get a form from both Venmo and Zelle that shows what the revenue from each platform was. I need this so that I can confirm that all sources of rental revenue adds up to the total revenue as shown in the income files. Let's open one of each of these file types to see what information we need from each one in order to populate the rental books file. Let's start with the 1098 form. This form will provide information that will contribute to our tax deductions. These include how much I paid for mortgage insurance, hazard insurance, and taxes, which in this particular form is called the escrow reconciliation section. Note, folks, different lenders may follow a different format, but what's important is that they provide all this information to you. For this home, that totaled to $13,067. Next, I also need to know the mortgage interest for the loan, which in this case came to $6,937. Although this doesn't help reduce my taxable income, I also care to know what the total principal paid was. The principal amount is effectively how much of the home value was paid, which is also referred to as equity that I gained towards the property. This remains an unrealized gain until I either sell the property, do a HELOC, or a cash out refinance. I talk in greater detail around home refinancing, its process, and when it's a good time to do a refinance in the above video above. If you have a lot of equity in your home and you are looking to tap into it, I strongly recommend you to check out that video. Okay, next up, let's take a look at the income statement files from apartments.com, which is actually a revenue statement. As you can see, this is incredibly simple. Per property, I just make note of the total income. For this particular property, I made a total of $46,311 in revenue. Pretty good. I don't call this income because this amount, for the most part, pays for the previous values we noted: the mortgage, repairs, utilities, and so on. On to the expense Excel file. This file is produced from the expense tracking file that I have used since, wait for it, 2015, where I track down every single expense that I have ever made. Just for giggles, folks, let's take a look at what I bought 10 years ago. Let's see, we've got scissors, toilet paper, dish sponge, Pringles, important, water, wait a second, stuff. I paid $5 for stuff back in January 10, 2015. What does a 22-year-old call stuff that's worth that amount? Comment on the chat below to let me know what you think this is. All right, back on topic, folks. If interested in how I built this level of financial discipline, check out the video above where I share my process and tips to remain on a budget. But this specific file is a copy of that file, and specifically filtered down to only include the housing expense type and for the relevant year. As you can see here, if I switch over to the other tab, this is the file I care about. I created this using basic Excel equations to help me group the expenses by property, specifically how much was paid for each utility type per property, as well as summing up the total repairs and renovations across each property. This is already a very good summary, but it's missing a very important detail, and that is the revenue per each property. This is where the final file type comes into play, the book Excel file. Using all the other files we have reviewed, I simply take the various values and bring them into this book file to summarize it in a very concise manner. That's the goal around taxes, folks. You want to organize files across all the different layers of detail. At the highest level, summarizing everything, and at the lowest level, files like the income statements or the expense file that shows very granular amounts and dates. This will be very beneficial to your CPA and yourself, especially when the IRS decides to audit you, which they will at some point, folks, as the IRS loves to target small business owners. As you can see, each row represents one property. The first column is where I note what the property's revenue was. This is informative because it provides me insight on which home is bringing the most or lowest revenue, which allows me to think as to why that's the case. Is it the house size, the location, the loan details like interest rate or loan amounts? All good information for me to think about. One thing to note before we move forward on this file is that the turtle home is currently where I live. And although I do rent the finished in-law suite in the basement, this is my primary residence, which will impact all of these columns. All right, next up, let's talk about the repairs column. This is useful because it informs me if a property is requiring more repairs than others. I definitely don't want to buy and hold a dud that requires constant high repairs. Occasional repairs are expected every year, of course. For my homes and in my area, I have found that anything between $1,000 to $3,000 is expected per property. On to the next column, utilities and yard work. Nothing much to say here besides these tend to be very similar across properties. Of course, there are exceptions if a home is larger than others, or if the renters crank up that heat or the AC very high. The lowest cost at $4,221 is, to no surprise, my current place of residence. I tend to be very utility conscious, and thankfully, so does my renter in the finished in-law suite. Compare that with the Shiloh home. At $6,418, this is contributed to this being my largest home, and also likely due to the renters using the AC and heat a lot more. The next column is the total mortgage, aggregating taxes, insurance, and the principal/unrealized gains. Shiloh has the highest here at $30,000 because it was one of my higher starting loan amounts and because my interest rate was around 5.5%. The lowest one is for Verbana at $18,000. This is because this home originally had the lowest loan amount at just $200,000, and it also had a great 3.5% rate at a 30-year loan. Onto unrealized gains slash equity, or the principal paid per property. Just take a look at the Zachary home with a near $13,000. Ah, yeah. This is only possible, however, because this has a 3% 15-year loan and was purchased back in 2018 and refinanced to those terms in 2019. And the longer you hold a home over time, the more goes towards the principal each month compared to early on in the loan, where most goes towards paying interest. This Zachary home is followed closely by $8,000 from the Logan property. This was an incredible 2.3% 30-year loan, which I bought back around 2020. And then Windridge at $7,000. This one is also a 15-year loan, but at around 6.5% interest rate. Turtle is the lowest because it is a 30-year, 7.3% loan. So you can start seeing and appreciating the huge difference that a 15 versus 30-year term can have when it comes to gaining equity. Moving on to cash flow. Off the bat, negative $19,000 cash flow for Turtle is not entirely accurate because this is my primary residence, so inherently, this isn't supposed to cash flow. This is basically what I pay to have a roof over my head. And for Logan Way, the only reason this is negative is because the current renter hasn't paid rent nor utilities in 3 months, which totals to around $5,000. Unfortunately, this individual has been evicted. If it was paid on time, this would have had an impressive $4,800 cash flow. Zachary, however, this one is truly cash flow negative just because the rent is just enough to cover the mortgage, but nothing more. So the repairs are always out of pocket, along with some of the utilities like pest control and the internet. But let's celebrate for Windridge at an outstanding $10,000 cash flow. Yeah, folks. The reason this is high is because this home started at the lowest loan balance than all my other properties, thanks to me putting down 50% as a down payment, which was around $155,000. I only managed to do this thanks to performing a 1031 exchange, which is when you sell a property and defer paying capital gains taxes if you use the profits to buy a similar like property. This was a brilliant move because the previous home that I sold had less than $2,000 in cash flow, but had appreciated significantly and provided a profit of around $130,000. The total cash flow tells me that due to all my investment properties, even with $5,000 of missing rent, I am effectively living mortgage free. If rent was paid on time, however, I would actually be profiting around $4,700 in the year after accounting for my primary residence cost. A big factor to this is that I am my own property manager. If I outsourced all this work that I do to a property manager, these numbers would look very different, likely anywhere from 8 to 12% lower. So hard work and discipline does pay off, folks. The profit margin column simply takes the cash flow and divides it by the revenue. This will tell me how effective the property is at making immediate income. The Turtle property, once again, is an exception. Given it is my primary residence, we never expected a profit for this. Windridge is our champion at an impressive 25% profit margin, followed closely by Verbata at 21%. Zachary, as we said, has a poor profit margin, but it makes up for it from the unrealized gains as we talked about earlier. This is why I have the last column, total gains, which adds up the immediate cash flow profit with the unrealized gains from the equity. This column is how I rank my properties. First place goes to Windridge, once again showing why doing a 1031 exchange can be an incredible power tactic for investors. Second place goes to Logan Way. This is the case because the current renter didn't pay $5,000 that they owe, so this would have actually been around $13,000 in total gains. And in third place, Verbana, due in part to a good interest rate at a 30-year term showing a good balance of cash flow and equity. But as you can see, folks, every property overall has been a great investment, averaging $11,000 in total gains across all my investment properties. This should also serve as a reminder, folks, that real estate investment is not passive. Let me reiterate that. It's not passive. It is an incredible amount of work. So don't do this if you're looking for passive income, or if you are looking for a short or midterm return. Real estate investment is definitely a 10+ year play. After 7 years in business, I am finally starting to see respectable gains. But in the beginning, it was pretty insignificant. If you found this video informative, please go ahead and give it a like, folks. Share it with others and consider subscribing to my channel to not miss out on future nuggets of wisdom. Also, I encourage you to check out my existing playlists, as there is something there for both homeowners, renters, DIYers, and property managers. I hope that this helps you understand and appreciate how you prepare for your taxes, regardless if you're in real estate or any other venture. It's all about being organized, and it's all about being very meticulous with the numbers. Thanks for watching again, folks, and till next time.